In investing, there is this term called catching the falling knife. And in one of my recent videos, a viewer that goes after Glenn has provided a pretty interesting comment. And I quote, "Your investing principle is unique, always going for the beaten down, unloved stocks, like a deep value investor, Baba, Chinese tech, and now Lululemon," unquote. And on a very personal note, I agree to the first half, but not the second half. So in this video specifically, I'm going to break down a little bit more in terms of my own investment framework, how I look at some of these unloved stocks, why I bought some over the others. And since you have clicked into this video and you're interested in what I'm going to say, please also remember to help me smash that cute little like button. But here was my reply to Glenn. Actually, even if you look at the other names in my portfolio, even for US big tech or even the semiconductor names, reverse engineer my entry because I've been averaging up. I scooped them when they were beaten down and are loved too. So yes, I do think that that's a pretty fair assessment. It just so happens that they've recovered a lot quicker and stronger, so suddenly they feel like they're being loved again. And here is the breakdown of this so-called falling knife portfolio that I've constructed over the last 4 to 5 years. So if you're just looking at this screenshot, all you'll be seeing are just a range of numbers and letters. I might be up 171% of my Taiwan semiconductor. Oh, good for you. But I think that's not the main takeaway of this video. Instead, let me superimpose the numbers with the storyline behind it. So let's of course start off with this Chinese tech bear market. And for those of you who are not aware, over the last 5 years, the Hang Seng, which is the index that tracks the Hong Kong market, is basically flat, while a better proxy to understand the state of the Chinese tech industry is probably KWEB, which is the Crane Shares China Internet ETF. And over the last 5 years, it's still down a royal 44%. And moving closer into the 3 companies that I own, which is in this whole Chinese tech space, namely Alibaba, Tencent, and Meituan, I've basically digged out my entire transaction records up until my first buy point, what date was it, and what's my current average price, and the lowest that they've been over the last 5 years. So of course, firstly, we have Alibaba Group Holdings. I think it has been one of my most talked about stocks. I've followed it for close to 4 or 5 years now. My first buy was actually back in end 2020, roughly around $220 per share. The lowest it has been over the last 5 years was around $60. And back then, there was a lot of hoo-ha and commotions around unprecedented third-term election and how the entire Chinese government and economy has lost its way. And over time, I think my average price was roughly $105 per share. I think not too shabby. Moving on to Tencent, I think I started a position much more later on, and I really took advantage of that huge significant drawdown during the 2022 bottom. And my average on Tencent is roughly 343. I averaged down and then I averaged back up. So it went back to my first buy point. And for Meituan, I think I really started a position much more later on, only in 2025, after they've ironed out a lot of their regulatory compliance and their stakeholder management. And more importantly, because of the context of the food delivery war today, that's why the share price is showing a lot of weakness. I think Alibaba and JD is also not spared. So my first buy was 153, and because I've been averaging down, my current average price is 138. But if you look back, I think at the bottom in 2024, they went to as low as $61 per share. And you can see that clearly I have never managed to catch the bottom. And from their peak, all 3 companies probably were down 60, 70, some even 80, 85%. And while we're talking about catching falling knives, make sure to also catch Phillip Capital's 50th anniversary rewards worth up to 2,200 Singapore dollars for new users. To celebrate their 50th anniversary, they're giving out some seriously attractive sign-up rewards for new users to Poems. So if you have never had a Poems account before, here's what you need to know. First, head to the link below to open a Cash Plus account. Second, opt in to Smart Park within 14 days. And third, you'll enjoy 0% commission trading for 30 days. And every week, the first 50 new users to Poems also receive a 50 Singapore dollar stock coupon depending on the weekly theme, ranging from Coca-Cola stock to even Nvidia shares. And if you fund your account within 14 days, you unlock additional reward tiers. At the minimum base tier, fund 3,000 Singapore dollars, hold it for 30 days, and make 3 buy trades. And you'll get a fractional Amazon share worth $50. And at the highest tier, you could walk away with up to 300 Singapore dollars worth of rewards. And Poems is not stopping there. In August, they will launch the second leg of this campaign called Fun and Flourish. So if you qualified during the June-July period right now as a new user, you just have to top up more funds in August and keep them in your account for the full month. And you'll receive even more stock coupons, up to $150 extra. So this isn't your average promotion, it's a golden window tied to their 50th birthday. And they're celebrating by giving back big. So don't miss out, links in the description, and thanks to Poem for sponsoring this video. And focusing on Chinese tech alone is not enough because we have not seen that sweet recovery. Instead, let's look at something where just catching the falling knife alone was enough to actually let you profit from it. So of course, let's look at US tech. So US tech alone over the last 5 years, if we were to remove out the entire pandemic V-shaped recovery, and the next most recent bear market was in 2022 due to the whole inflationary/recessionary scare. And in my own portfolio, I think these 3 tech companies hold a much sizable position. And I'll leave Nvidia out for now. So I first bought Amazon at roughly mid-2022, and my first buy was roughly $102 per share. The lowest they went was actually $81, but my average right now is roughly $155. Clearly because I was averaging upwards as well. And Amazon, I think the story back then was that there were a lot of frivolous capital spending. Amazon's new CEO, Andy Jassy, lost his way. I think the entire retail business back then was not pulling its weight. They're investing very heavily in their entire logistics network, but it's not showing up in terms of their income statement. And investors were probably skeptical that this multi-trillion-dollar company is just propped up by the AWS engine itself. Moving on to Meta, I think my first buy was $215, also in that 2022 period, and the lowest it went was roughly $88. That's more than a 50% drawdown. The average price currently that I have is roughly $328. Clearly, because I've been averaging up as well. And looking at Meta platforms, at their lowest, they were embroiled in a lot of scandals, slowing growth, TikTok competition, the privacy issue with the entire Apple tracking system, so on and so forth. And moving on to Alphabet, I've also bought them at closer to mid to end of 2022. My first buying price was $106, the lowest they went was $83, and my current average price is $154. Alphabet is still currently in a very precarious position with the entire ChatGPT, agentic LLMs, and all those kind of stuff threatening their core Google search business. So with all these in mind, looking at both Chinese and US tech, it's a story of 2 tales. One already experienced the recovery while the other still languishing there. I think let me front load you with a few lessons here. Firstly, I think markets always move in cycles, and good companies will go on sale from time to time. Don't worry about it. And it depends on whether you can spot them and also have the capital or knowledge to take advantage of it. Usually, I'm saying usually, when you do catch these sort of quote-unquote falling knife stocks, momentum actually works against you. And you have to be ready to sit through longer drawdowns. And in fact, just looking at these 6 simple case studies, more often time than not, in fact, I would argue at every single one point in time, I never managed to catch the bottom. And some of them went on to continue going down by more than 50%. Thirdly, I think some knives definitely do recover faster than other knives. And not all knives are made equal. And in the short term, I think anything can happen because it's mostly the recovery or the deterioration of sentiments or demand and supply. And the last few case studies that I'd like to bring to your attention, I think right now, everybody's talking about AI. And some of these very popular names like Nvidia, Taiwan Semiconductor, and ASML is at top of mind for most investors. I only bought into Nvidia and ASML in 2025 because I was doing a lot of the research and groundwork before I commit any capital. So specifically for Nvidia, I only bought them during the Trump tariff season. My first buy was $113 and the average price was $104. I didn't include the lowest 5-year price because clearly I was not even in the market to understand Nvidia at their lowest traded record. But if you want to just focus on the recent price action, at the lowest, I think they went to $88 per share. And today at $172, that's close to a 2x. And you can clearly see how fragile or how quick sentiments can change for better or for worse. Similarly for ASML, in terms of their recent price action, in 2025 alone, I think the price range is around $600 to $800 per share. My first buy was $675 and my average price was $720. Moving on to the last one, which I had a much more fruitful and longer term experience. For TSMC, I actually did have my first buy at $84 in the 2022 bear market. My average price is roughly $88, and the lowest they went was around $59 per share. I think circling back to the logic of buying stocks when they are quote-unquote unloved, I think that my own portfolio and track record speaks for itself, that I do like engaging with stock picks when it's out of season, especially when they are very, very down from their all-time high. Not saying that because they are cheap, but they are, relatively speaking, buying at a discounted price compared to those that are chasing the momentum. However, I do think that there are clear distinctions that needs to be made between an economy, a sector, or a company slowdown. And they're definitely very different. On an economy-wide slowdown, that's basically a broad-based bear market in 2022 where people were concerned about recessions, or back in 2020 because of the pandemic. Compared to sector slowdowns, like in the semiconductor slowdown, that roughly coincided with the 2022 pullback as well. And the last part, which is a company slowdown, and that is a lot more trickier because you do have to make your own judgment comparing the valuations, the drawdowns, and their competitors in that same space. And why is it only that particular company experiencing that falling knife phenomenon while the other companies in that industry are doing pretty well? Now, there is also an important caveat here is that yes, I think when you're so-called buying quote-unquote unloved stocks, it means that you're being contrarian. And I think it has been a dogma or like an entire DNA of the value investing community of some sort that they want to be contrarian. And being contrarian means that you're being associated to something good. But being contrarian for the sake of it is useless. For example, thinking that the US market is at all-time high today and selling out because you don't want to be partying together with the rest of them, just because you want to be contrarian is not good enough. You must be contrarian and it needs to be right in order for you to reach that end goal, which is outsized returns. So the general investing philosophy that you see most people preach is that, just buy good companies and buy it when it's cheap. And you can understand these concepts from the idea of margin of safety, buying below intrinsic value. And those theories are definitely good and upright. But I think it's usually easier said than done. And here's the question that I'll pose back to you. Why do you think good companies will be selling at a discount? And why do you think cheap companies will be good? And the larger question that you have to answer is that what is the market actually missing? And when you're trying to grasp this concept of buying good companies when they're cheap, sometimes you can come across this 2x2 dimension because you're just comparing two different variables, good versus bad company and cheap versus expensive. But the truth is, it's always somewhere in between. So yes, you want to buy good companies and it's cheap. And going back to my question of what do you think the market is missing? And when there really are such opportunities, then they tend to be unicorns. Comparatively, when looking at bad companies and they're cheap, there are many of such companies. On the other hand, when good companies are expensive, I think you have a moderate amount of them because, as you know, these companies are good. Other people, other investors, other market participants also know that they're good. So usually you do find quite a few of them that are expensive that are trading in the market. And on the flip side, you have bad companies that are expensive. And I do classify them as meme stocks. Usually, they don't move on fundamentals, but on some other things, such as giving the middle finger to the hedge funds. But that's besides the point. But when trying to dive deeper into this so-called quote-unquote investment framework, I think it's not so easy. Because in fact, it's not just a 2x2 matrix. It's actually a continuum, where it's a scale where sometimes good companies can slowly turn bad or meet until some temporary issues that make them look bad. And on the flip side, it's not such an easy comparison or benchmark saying that this company is cheap or expensive because of the level of valuation expectations that are being priced in, growth expectations, and so on and so forth. And ultimately, what you're trying to do here is to hunt for this unicorn called mispricing, where good companies that temporarily look not so good, and you can buy them at bargain prices because people are selling out their positions. So there are some real life personal examples that I've actually shared in some of these case studies just now, where you have Meta with their Apple tracking policy. They were clamping down on their targeting. You have your TikTok competition, layer in slowdown in growth of users, and also the metaverse distraction. And that's how you see Meta's share price going from $300 over to $88 in just a short span of like 9 to 12 months. Things like an industry-wide slowdown, especially in the semiconductor manufacturing space, and TSMC saw that very huge drawdown in 2022 as well. So how do you differentiate between good versus bad company? Is it temporary or structural? That's where you see this continuum. And it's not so easy to say that, it's a good company versus a bad company. And here are some lessons that I took home over the years. Firstly, don't think just because you bought the falling knife stock that has already went down 30 to 50% from its all-time high, thinking that you got a discount, means that it cannot drop another 50 to 75% from your entry. Take it from me, I've experienced it myself. But of course, I think if it's not a very, very bad bear market like the Chinese tech bear, plus if it's a pretty solid company, it wouldn't go down too badly. But if you compare it with those that are growth or momentum oriented, actually they can go down 70 to 90% quite easily, especially for investors that sat through the 2022 valuation reset. So in this comparison, I can't put a specific probability, but I do believe that if you're adopting the falling knife philosophy, you won't see that kind of 90% drawdown unless you really misjudge the company and it became a pretty trash or pretty bad company. Secondly, I think it also sounds intuitive to buy when stocks are going down. But I think when you're buying a stock that is seeing a cliff-like drawdown, you must acknowledge that there is some cracks that the market is trying to price in here. And by buying into it today, you are basically giving everyone else the middle finger. And you could very well be wrong, if you have made the wrong assessment, of course, and you need time to play out. I think despite buying at a relatively quote-unquote cheap price, if you just look at the price action alone, but don't be anchored to past entries, and you can always average up to continue building the position too, if you do deem your thesis and analysis still intact. And now, I think to put things into perspective, after we've discussed this entire falling knife philosophy, I just wanted to ground you in some of these case studies that have came my way and to also share my own experience and thought process when looking at some of these investment opportunities. And clearly, I'm a very big Chinese tech bull. And I'm definitely not afraid of some of these regulation concerns and some of these other risk factors. So on top of these three tech companies, I've actually spent quite a bit of time looking at some of these other companies that are also trading at dirt cheap valuations, price action, everything down the drain. Companies that came to mind in this Chinese tech space is namely Baidu and JD.com. So just to show you a few of the numbers to get you have an appreciation in terms of why some of these quote-unquote value investors are very interested in it and constantly pitching it my way, is that look at Baidu. Baidu is trading at a forward PE of 10. Their revenue growth is a little bit erratic, sometimes going up 10% and then flat or down by 1-2%. Margins held steady, and they are at a $30 billion market cap. They have $20 billion in long-term investment, 19.7 billion in cash, and $11 billion in debt. You are basically buying a so-called net company because the long-term investment and their cash, netting off their debt, means that the entire market cap is valued in just their long-term investment alone. And their search and their Apollo Go, which is their self-driving, everything is free of charge. And they're still printing cash at a very healthy level with margins staying steady. Moving on, I think JD, another company that is in that so-called same category, forward PE at 11.6. Revenue growth still healthy at 5 to 10% over the last 3 years. Margins are also steady. In fact, they're growing a little bit and they're currently trading at a $49 billion market cap, $17 billion in long-term investments, $27 billion in cash. Adding them up together, that's $44 billion minus $8 billion in debt. So that's $36 billion to a $49 billion market cap. You are really not paying much. $15 billion for their core e-commerce business and their food delivery network, and probably some exposure in other investments as well. So when looking at these two companies, to be very, very frank, I was at first tempted, no doubt. Just looking at the numbers alone, of course, assuming that they are not pulling numbers out of their ass, and you can believe their investment mark-to-market value and the cash in their bank, if all these are real, if you want to punt for a so-called mean reversion, because a lot of all these bearish sentiments are pushing the stock price to too far an extent, sure. And in fact, there is a whole body of literature talking about this version of value investing, i.e. deep value investing. So personally for myself, I don't necessarily identify with that category of investors. That's why in that very first part where I alluded in the comments, I don't identify or I don't agree that I'm doing deep value investing. So for those of you who are, then these companies might be up your alley. But I prefer companies that, yes, they are hit by short-term bad news. They offer very, very deep discounts. But at the same time, I really do see a very long growth story, a trajectory of growth that I can allocate my capital and not be too concerned, at least in the medium term, of always trying to recycle my capital, of looking for the next opportunity. And looking at the other three companies, Alibaba, Tencent, and Meituan, they all have something going for them. Whether it's in AI, in cloud, in robotics, in social media, in games, whatever it is, they definitely have a quote-unquote much more brighter future compared to these two. And notwithstanding the fact that, yes, Baidu has a very attractive Apollo Go with their whole full self-driving thing, maybe personally I'm not as bought into the entire idea. You point a gun at my head and to choose one over the other, clearly I will choose Baidu because of my understanding and my reasoning. But one thing that you have to take note, especially in this whole Chinese tech space, and execution is a very, very important thing, is that these two companies, the management team definitely dropped the ball and they didn't execute as well, and they are definitely left behind. And there is a very, very evident market mechanism reflecting that view, which is in their market cap and why they have been traded down by such a large extent. So I'll leave it at that, but I do hope that you kind of get that distinction when I do that comparison amongst some of these Chinese tech companies. And also, to be fair, let's not stop at the Chinese market. When looking at the US market, there are also quite a lot of the value investing community talking about some of these companies, and namely, off the top of my head, I can remember it's actually Intel and PayPal. So I think these stocks are popular because they're considered so-called turnaround stocks. They are traded at very, very cheap valuations compared or relative to their history. And usually they are probably either caused by underinvestment, weak leadership, misplay or misguided execution and things like that. So for myself, actually, I do try to stay away from turnaround stocks unless it gets really, 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 really attractive. Looking at Intel, comparing to the company that I own, which is TSMC, and looking at this entire AI growth curve and how Intel can still be experiencing negative year-on-year growth rates, I really am not interested in the business. And yes, I do understand a lot of people are saying that because and due to their very basement level expectations already, all they have to do is to just outperform by a little bit, and then there is a very high probability of a re-rating. But for myself, I just don't see me betting money in some of these turnaround plays. So I do hope that through some of these case studies and examples, you get a better appreciation of how I look at allocating the capital. And with that in mind, I think I'll see you guys in the next video. And more importantly, but hopefully, I'll see you guys on the moon. Goodbye.